Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. 3M has been one of those stocks that has been a phenomenal buy and hold for decades, but over the last 10 years, a lot has changed at 3M, and this may be one of those stocks that's more value trapped than it is value right now. 3M's dividend yield is 5.7%, which looks really attractive, but if we look back at the history of the company, it's actually underperforming the market by a wide margin over the last 10 years. And the reason for that is what I want to get into today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And I want to start with the performance chart for 3M. This is 3M's total return over the last decade, about 28%. That includes dividends. If you take out dividends, the stock is actually down over the last 10 years. But that compares to the S&P 500's total return of nearly 230%. So underperforming the market by a very, very wide margin. The question is, why is that the case? And I think the reason is pretty clear when you look at this. Revenue over the last 10 years only up 10.4%. So on a compound basis, revenue is growing less than 1% a year. There are a few reasons for that. 3M has sold off some businesses, but this is absolutely not the kind of company that's an organic growth company like it has been really going back to its founding. On a gross profit perspective, you can see that gross profit is actually down almost 12%. So that's telling us that margins are getting compressed at 3M. That may be because of competition. It may be because different business models are coming in, taking some of 3M's potential business. But at the end of the day, revenue is not growing and margins are getting compressed. So that's kind of a double whammy if you're an investor. And the final thing here is that return on assets, which is a key profitability metric. 3M is still a manufacturing company. So they're going to do things like build manufacturing plants, and you want to generate a return on those assets. But the return on assets is actually down about 10% in the last decade and just seems to be trending lower and lower. The irony here is that 3M has been focused on efficiency for 2 decades now. When Jim McNerney came in the early 2000s, he brought Six Sigma. There's a lot more focus on listening to the customer, on doing even the smallest tasks more efficiently, but the payoff has simply not been there for the company or investors. 3M announced another round of layoffs earlier this year, and it seems like the innovative culture that drove the company's growth for decades to iconic products like Scotch tape, Post-it notes, even brightness enhancement films that are probably in the device that you're using right now, those kind of innovations just simply haven't come out of 3M over the last 2 decades. And I think really one of the reasons why is because of this focus on efficiency. It's sort of an ironic outcome, but when you put a metric to everything, that means you eliminate creativity in a lot of different ways. The problem for 3M is I simply don't think you get that back. And right now, 3M is in cutting mode. They're selling off assets, they're cutting employees. You're not going to get back to a point of organic growth, of creativity, of innovation that really built 3M into what it is today. And the financial results are not looking great. Return on assets falling, margins falling. That's going to put more and more pressure on efficiency. And it seems to be just a downward spiral for 3M. So this stock looks great at a 5.7% dividend yield, but I would caution investors that that looks more like a value trap today than it is a real long-term value. But what do you think? Leave your comments in the comment section below. Don't forget to follow Asymmetric Investing. Thanks for watching, everybody. See you here next time.